Hi everyone, welcome back to my channel. Today we'll be discussing tax consequences of employing your family or yourself. Whoever said never hire your family members must not have read the tax code. The tax law makes it highly advantageous for business owners to hire family members. Employing your children. If you hire your children as employees to do legitimate work in your business, you may deduct their salaries as a business expense. Your child doesn't have to pay tax on that salary if it doesn't exceed the standard deduction. Furthermore, if your child is under the age of 18, you won't have to withhold or pay any FICA, which is Social Security or Medicare tax on the salary. This can result in substantial tax savings. Furthermore, you need not pay federal unemployment taxes or FUTA for services performed by your child who is under 21 years old. However, these rules do not apply, and you must pay both FICA and FUTA if you hire your child to work for your corporation or your partnership, unless all the partners are parents of the child. You need not pay FICA or FUTA if you have formed a one-member limited liability company and hire your child to work for it. For tax purposes, a single-member LLC is a disregarded entity, that is, it's treated as if it didn't exist. In addition, if your child has no unearned income, for example, interest or dividend income, you must withhold income taxes from your child's pay only if it exceeds the standard deduction for the year. The standard deduction for a dependent child is total earned income plus $350 up to a maximum of $12,200. Thus, a child can earn up to $12,200 without paying income tax. However, the rule changes when your child receives income from sources other than employment. If a child has both earned and unearned income, he or she must file a return if unearned income is over $1,100, earned income is over $12,200, or earned and unearned income together total more than the larger of $1,100, or 2, total earned income up to $11,850 plus $350. A child who has only unearned income must file a return if the total is more than $1,100. If your child's unearned income only consists of interest and dividends, then you can elect to include it on your own return and combine it with your income. Do this by completing IRS Form 8814 and attach it to your personal tax return. Note, to combat the economic downturn caused by COVID-19, the IRS sent stimulus checks to most Americans. Adults received $1,200. Parents received $500 for each child under age 17. Children over 17 didn't get anything if they are dependents of their parents. These payments are not taxable income and do not count as unearned or earned income for parents or their children. Employing your spouse. You don't get the benefits of income shifting when you employ your spouse in your business because your income is combined when you file a joint tax return. You'll also have to pay FICA taxes on your spouse's wages, so you get no savings there either. However, you don't need to pay FUTA tax if you employ your spouse in your unincorporated business. This tax is usually less than $50 per year, so this is not much of a savings. The real advantage of hiring your spouse is in the realm of employee benefits. You can provide your spouse with any or all of the employee benefits, then you can take a tax deduction for the cost of the benefit, and your spouse doesn't have to declare the benefit as income. For example, health insurance. You can give your spouse health insurance coverage as an employee benefit. Another benefit of hiring your spouse is that you can take business trips together and deduct the cost as a business expense, as long as your spouse's presence was necessary for your business. Rules to follow when employing your family. Rule number 1, your child or spouse must be a real employee. The IRS won't believe that an extremely young child is a legitimate employee. How young is too young? The IRS has accepted that a 7-year-old child may be an employee, but probably won't believe that children younger than 7 are performing any useful work for your business. Rule number 2, compensation must be reasonable. Check with an employment agency in your area to see what the workers are being paid. Rule number 3, comply with legal requirements for employers. So at the time that you hire, when you first hire your child or spouse, you must fill out IRS Form W-4. You, the employer, use it to determine how much tax you must withhold from the employee's salary. A child who is exempt from withholding should write exempt in the space provided and complete and sign the rest of the form. You must also complete U.S. Citizenship and Immigration Service Form I-9, Employment Eligibility Verification, verifying that the employee is a U.S. citizen or is otherwise eligible to work in the United States. Keep both forms. You must also record your employee's Social Security number. If your child doesn't have a number, you must apply for one. In addition, you must have an employer identification number or EIN. If you don't have one, you may obtain it by filing IRS Form SS-4. Every payday, you'll need to withhold income tax from your child's pay only if it exceeds a specified amount. You don't have to withhold FICA taxes for children younger than 18. You must withhold income tax and FICA tax for your spouse, but not FUTA tax. If the amounts withheld plus the employer's share of payroll taxes exceed $2,500 during a calendar quarter, you must deposit the amounts monthly by making federal tax deposits electronically with the IRS. You can make these deposits yourself using the IRS's free electronic federal tax payment system, or EFTPS. Now, every calendar quarter, if you withhold tax from your child's or spouse's pay, you must deposit it with the IRS. If you deposit more than $1,000 a year, you must file Form 941, Employer's Quarterly Federal Tax Return, with the IRS, showing how much the employee was paid during the quarter and how much tax you withheld and deposited. If you need to deposit less than $2,500 during a calendar quarter, you can make your payments along with the Form 941 instead of paying monthly. Employers with total employment tax liability of $1,000 or less may file employment tax returns once a year instead of quarterly. Use new IRS Form 944, Employer's Annual Federal Tax Return. You must receive written notice from the IRS to file Form 944 instead of Form 941. And each year, by January 31st of each year, You must complete and give your employee a copy of IRS Form W-2, wage and tax statement showing how much you paid the employee and how much tax was withheld. You must also file copies of the W-2 forms with the IRS and Social Security Administration as well. You must include IRS Form W-3, transmittal of wage and tax statements, with a copy you file with the Social Security Administration. If your child is exempt from withholding, a new W-4 form must be completed each year. You must also file Form 940, Employer's Annual Federal Unemployment Tax Return, or FUTA. The due date is January 31st. However, if you deposited all of the FUTA tax when due, you have 10 additional days to file. You must file a Form 940 for your child even though you are not required to withhold any employment taxes from his or her pay. If your child is your only employee, enter his or her wage as exempt from unemployment tax. Employing yourself. If you are a sole proprietor, partner in a partnership, or a member of a LLC, you are not an employee of your business. You are a business owner. However, if you have incorporated your business, whether as a regular C corporation or an S corporation, you are an employee of your corporation if you actively work in the business. In effect, you'll be employing yourself. This has important tax consequences. Your incorporated business must treat you just like any other employee for tax purposes. This means it must withhold income and FICA taxes from your pay and pay half of your FICA tax itself. It must also pay FUTA taxes for you. It gets a tax deduction for its contributions just like any other employer. You can't avoid these payroll taxes by working for free. The corporation must pay you at least a reasonable salary, what similar companies pay for the same services. Now, when you are an employee, your incorporated business can deduct your salary as a business expense. However, you will have to pay income tax on your salary, so you won't realize a net tax savings. But being an employee can have a significant upside. You'll be eligible for all of the tax-advantaged employee benefits. This means that your corporation can provide you with benefits like health insurance and deduct the expense. If your corporation is a regular C corporation, you won't have to pay income tax on the value of your employee benefits. However, most shareholders/employee of S corporations must pay tax on their employee benefit, so you probably won't get an overall tax savings. Employees of an S corporation who owns less than 2% of the corporate stock don't have to pay tax on benefits, but it's unlikely you'll have this little stock in your own S corporation. Your corporation should reimburse you or pay directly for any expenses you incur while working for your corporation. For example, when you travel on company business. If you comply with the requirements for an accountable plan, your corporation gets to deduct the expense and you don't have to count the reimbursement as income to you. If you fail to follow the rules, you must treat any reimbursements as employee income subject to tax. You may not deduct any expenses you incur as an employee on your own personal tax return. This deduction was eliminated by the Tax Cuts and Jobs Act starting in 2018 through 2025.